In this week's video, we'll review the latest charts to help us answer the question, are we dealing with a tired or rejuvenated stock market? On Friday morning, June 4th, the monthly labor report came in below expectations. We're still in a situation where the Fed is talking about remaining patient, but at the same time, they're sending signals that say at some point in the not too distant future, we are most likely going to start talking about tapering. We originally covered the chart on the left side of the screen, the 2003 case, and the chart in the middle of the screen, the 2009-2010 case, on April 30th. Here's the same SPY-TLT chart during Friday's session. This is late in the session, 324. Really don't have any resolution here. And while the S&P 500 was up 36 points, it closed up 37. This ratio actually deteriorated during the day. At 11:19 a.m. on Friday, it was down 0.14. Here at 3:24 p.m., it was down 0.37%. The close was even worse at 0.45. This ratio is showing hesitation, indecisiveness. There's no real resolution here. However, there's definitely some concern in the short term, most likely about the Fed. You can pause your video player and review this ratio or these charts in more detail. This is Treasury inflation protected securities TIPS relative to standard treasuries. Left side of your screen is the 2009-2010 case. You can see inflation expectations where my cursor is, rising off of the low in March of 2009, and then they start to wane in 2010, and eventually the S&P 500 has a significant give back. Chart on the left side of the screen is an 18-month period. Right side's the present day, June 4th, 2021. It spans approximately 15 months. Probably fair to say that we have a strong rising trend and possibly a trend that looks like it's losing some momentum. But this still looks better than this. If we zoom in on the present day and add a daily momentum indicator, Williams %R, you can see momentum definitely needs to pick up steam here in terms of confidence relative to inflation expectations. Typically, rising inflation expectations are good for risk assets, and increasing deflationary expectations typically are not particularly good for risk assets. You can see when the S&P 500 peaked in 2010, the ratio made a discernible lower high after breaking the trend from the March 2009 low, and eventually went on to print a lower low. This is where the S&P 500 peaked here. In the present day, to get a little bit more confident about a risk-on status or confident about the potential for a sustained leg higher in risk assets, we really like to see momentum morph from this look here, where it is in the present day, to something more like this. This is more of a confident look as stocks rallied off of the late October, early November lows. We'd like to see this look here morph into this look here. That may happen, but it hasn't happened yet. It's been approximately 300 trading days since the March 23rd low in the S&P 500, where my cursor is. This is showing you the rate of change for inflation expectations, the rate of change for the ratio in the top panel on each side here. After the 2009 low, the apex was hit on February 9th, 2010. In the present day, it's possible the apex was hit on June 1st, but we really don't know that. You could have said the same thing here, and eventually we went on to make a higher high. Given we've had such a big and rare move in the TIP-IEF ratio since the March low, we wanted to know, how did the S&P 500 perform after the rate of change did hit the apex here in February of 2010? The answer is somewhat of a mixed bag. This is February 2010, February 9th here, the date of the apex and the rate of change. sharp rally, but then it was all given back in a Nordique-type fashion. The S&P 500 gained an additional 13.71% over 73 calendar days, and then gave it all back and then some over the next 70 calendar days. As we've mentioned in recent weeks, it might be relatively easy to see a figure like this in the lower right-hand corner of your screen here and become overly bearish about the longer-term outlook. We should keep in mind that S&P 500 performance from this point here, or February 9th, 2010, was extremely satisfying after this 16% give back. The market was 68% higher 4 years later, 150% higher 8 years later. And in terms of redeploying new capital in the present day, had you done something similar on February 9th, ultimately you would have lost money. The 1-year maximum drawdown from February 9th, 2010, looking out again a full year, was 4.48%. And the takeaway for us in the present day, we know what this looks like here. If we continue to trade the charts in front of us, including the look of the ratio in the present day, we should learn something about the market's tolerance for risk. We covered these two charts a week ago and said they had work to do. Really, everything we said about this chart and about this similar ratio here still applies as of Friday, June 4th. Have not gotten back over this level here in either case. We'll learn something either way. Somewhat of an indecisive look in the very short term. We have many charts like this, especially ones that are related to tech. ARKK versus TLT, defensive bonds, still clearly in a downtrend. Friday, June 4th at 3:11 p.m. Eastern Time, it was up 0.6% at 3:11 p.m. The close was even worse, 0.57. No change here. We'll learn something if we get out here or make a lower low here. You may remember this slide from recent videos. Really not a whole lot of significant change over the past week. Slight improvement for the bulls. The high during Friday's session was 42.33. We didn't exceed the intraday high from May 7th. Would like to see that. The longer we can stay in this general area here, the higher the probability we make a run at this level here, the same level we've been showing in these videos for several weeks, which is 43.28. That is approximately 2.3% above Friday's close. This chart was intraday when the S&P was up 36 points. The close was basically the same, up 37 points and change. This is a monthly chart of the value line geometric index as of month end, the last trading day of the month in May of 2021. The lower portion of your screen down here shows the 14-month rate of change. Why 14 months? It's been approximately 14 months since the major low in the S&P 500 was made on March 23rd of 2020. As you can see on the right side of the chart, rate of change has exceeded this green horizontal line. That's only happened 3 previous times. After the major low in stocks in 2009, after the major bottoming process in stocks in 2002 and 2003, and then we have to go all the way back to the major secular low made in 1982, and then we have the rally here into 1983. As you can see, the 14-month rate of change is in rarefied air here. It rarely gets up to these levels, and thus we wanted to know when it finally peaked here, here, and here, how did the stock market perform walking forward? Keep it in mind that the 14-month rate of change apex in the present day still falls into the to-be-determined category. The table shows S&P 500 performance walking forward from the date of the apex, which is month end. You can see in the short run there's a lot of yellow and red in this table, quite a bit different from the longer-term view. Also might be helpful to know, what did the maximum drawdown look like from the end of the month in each case when the apex was finally hit. The table here shows the maximum 1-year drawdown in each of the historical cases, the average drawdown roughly 10%, the median drawdown a little closer to 11%. As human beings, it's very, very easy to look at the left side of this table here and to look at these maximum drawdowns here and decide in advance that really, really bad things are about to happen in the stock market. The historical studies help us prepare for a wide range of outcomes. In the short run, this helps us with realistic expectations about some type of significant give back or the possibility of a significant give back. It's also extremely important to keep in mind a topic that we covered back on April 23rd. The major wild card in today's market is Fed policy. And as noted a week later at the end of April, right now Fed policy is extremely easy and loose, which is another way of saying extremely favorable for markets and risk assets. You can pause your video player to read the information from Cornerstone Macro in greater detail, but the bottom line, message from the Fed earlier this week, stay the course and look through recent strong inflation data. If Fed policy remains favorable for longer than market participants expect, it's possible a drawdown of this magnitude may be delayed for several weeks or even several months. We have a Fed that thus far has made no significant changes to their policy, and we have an economy that's showing continued signs of improvement. Now let's shift gears and look at the value line geometric index from a little bit different perspective. Originally, we looked at the apex for each one of these cases if the rate of change made it at least to this green line. If we review only the strongest of strong rallies, that eliminates the 2003 and 2004 case and keeps 82, 83 on the table, 2009, 2010, and the present day case on the right side of your screen. In the 2003-2004 case, we rally into October of 2007, and then really, really bad things happen. In the 82-83 case and 2009-2010 case, that's not what happened. In fact, you can see on your screen here that stocks did extraordinarily well looking out 10 years after getting through a realistic and reasonable period of volatility after such a big move off of these major lows. Thus, the big picture message really hasn't changed much. In these historical cases, if you wanted to get to the right side of the table, when you were in here, it was extremely important to have realistic expectations about 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. Also still relevant based on something that just happened at the end of May, the weight of the evidence continues to say we can maintain a longer-term focus as long as the present-day data allows us to do so. The green line was one way to look at this chart. The blue line was a second way to look at it. Now let's move away from the 14-month rate of change in the bottom of the screen and let's just look at price. You can make an argument that this point A, this point B, this point C, which is lower than A, and then point D, which is lower than B, is very, very similar from a fractal perspective to this point A, this point B, this point C, and this point D. You can also make a rational argument that this point E, which exceeds C and A, is similar to this point E, which exceeds C and A, and this point F after this give back similar to this point F. Then we get a strong reversal and we move, a strong reversal and we go on to make a higher high. Thus, one way to look at this chart, one of many possible ways to look at this chart, is to say that this breakout here is similar to the breakout that we experienced earlier this year. Thus, from a fractal perspective, this point here, similar to this point here. What happened here? Started working on Wall Street in 1994, so I can tell you firsthand that what happened from this point here was very, very favorable to longer-term investors. And really, the more important thing here is the consolidation analogy. This consolidation box here is roughly 8 years. The longer a market goes sideways, the bigger the move we can expect to get. In this case, a very, very similar consolidation box drawn in a similar manner between point A and point F is 23 years long. The longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout, which is what we have today, or a bearish breakdown. Notice in both cases, you got a bullish breakout, somewhat of a failed breakout look, and then you went on to make a higher high. A bullish breakout, somewhat of a failed breakout look, a shakeout, and then we went on to print a higher high. The value line geometric index is good for helping us track the average stock. It's a way to potentially look at the average performance of the average investor's investments. It's a way to look beyond the S&P 500 and the NASDAQ. If we zoom in here, this high on a monthly chart was made as of month-end June 1995. Thus, might be helpful to know, how did the S&P 500 perform walking forward from June 30th, 1995? The answer? Extraordinarily well. The S&P 500 tacked on an additional 180% between point A and point B in the spring of the year 2000. Now keep in mind, this is 180% after 8 years of consolidation. The longer a market goes sideways, the bigger the move we can expect to get. In this case, you can make an argument that we have 23 years of consolidation, simply helping us keep an open mind about much better than expected outcomes looking out several years. How is it possible that a strong rally like this could occur walking forward? There are numerous answers. Longtime viewers of these weekly videos know that one major factor relative to a potential much better than expected outcome looking out, let's say 5 to 10 years, is demographics. In 2021, the oldest millennials in the United States turn 40 this year. Also noteworthy, millennials with bachelor's degrees or higher earn 113% more than what they would have earned with only a high school diploma. Significantly better than getting a college degree if you were a baby boomer. This 113% number for the millennials was only 57% for the baby boomers. Thus, in terms of the data that we have in hand, education has become a greater predictor of success. And why is that relevant? Because the millennials, by far and away, are the most educated generation living and driving economic outcomes today. We hear a lot about how the millennials are behind, and they are a little bit behind, but it's extremely important to keep in mind the oldest millennials are turning 40 this year. And typically, U.S. consumers' peak earnings, spending, and investing years don't occur until between the ages of 35 and 55. And the midpoint of the age range for the millennials this year is 32.5. They're not even there yet. For the most part, they have their entire peak earnings, spending, and investing years ahead of them. Something that seems to align perfectly with this chart that's been consolidating for 23 years. The longer you go sideways, the bigger the move we can expect to get. The longer you go sideways, the bigger the move we can expect to get. In this case, the move from this point here was extremely satisfying, especially over the next 2 to 3 years. There's really nothing new here in terms of dealing with these probabilities on the left side of the table. We've covered all of this in the past, and it still applies. We don't trade historical studies. We trade the charts and the data in front of us. What does that mean? Right over here in the upper right. We get bearish when the present-day charts and data get bearish. And for clients, the purpose of all of this is to help us answer the question, are we currently allocated in line with the weight of the evidence? As of the close on Friday, June 4th, the answer was yes. Basically, what we've seen in recent weeks is as follows. Really haven't seen a whole lot that tells us we should be taking any additional risk. We really haven't seen a whole lot that tells us we should be reducing risk. As always, all of the statements in this week's video are based on the facts that we have in hand. And we all know the best way to handle all of this is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.